Thank you. I cannot wait for this panel to speak on crypto because we really have some fascinating people here. Allow me to introduce them very briefly, and then each of them will introduce themselves in turn and mention something interesting about their background and what they're doing in their current roles. So first of all, here we have Radhika Iyengar. Hi, how are you?
How are
She's
you?
the founding partner of StarChain Ventures. We have Franklin B, Director of Portfolio Development at Pantera Capital. Then let's see, Felix, who is the Chief Investment Officer of CoinFund. Hi. And LaVecchia. Of course, Pat is the CEO of Oasis Pro Markets and Oasis Pro Inc. Hi, and of course, he's a frequent speaker at these events. Welcome, everyone. And if you would, if you'd like to introduce yourselves and include something that you'd like to share with the audience, and of course, something that is pertinent to the next hour's discussion. Radhika, we'll start with you.
Thanks, Julia. Such a pleasure to be here with everybody. Really looking forward to this panel. So I'm Radhika Iyengar, founding partner of StarChain Ventures. We're a venture studio based here in Silicon Valley. And notable relevant point, I'm a co-author of Enterprise Blockchain Has Arrived, published in 2019, and we're very active in the blockchain and crypto space in the last 5 years or so, something like that. So super excited to be here, and I think we're gonna have a great discussion. Over to you, Julia.
Thank you. Franklin, go ahead.
Thanks, Julia. Great to be here. So I'm Franklin with Pantera Capital. Pantera has been investing into the blockchain and cryptocurrency space since 2013. We launched the first institutional Bitcoin fund in the US. And since then, we've expanded into early stage venture and early stage token investing. Today, we are raising a new fund, the Blockchain Fund, which is essentially a multi-strategy of all of our previous investing approaches. And we think it's the state-of-the-art way of investing into this space. I guess to date, we manage about $6 billion in assets. For myself, prior to Pantera, I was at JPMorgan, focused on launching the blockchain team there back in 2015. And I guess one interesting thing about that was I authored the first patent for asset tokenization for JPMorgan. So now that that's sort of seeing a bit more usage, I'm pretty curious about how that's all going to turn out.
Wonderful. Alex, you're next.
All right. Well, great to be here with you all, and always nice to speak to Marty's community. I remember doing some in-person events a number of years ago when crypto was first on the tip of the tongue of the family office community. I'm the CIO at CoinFund. We're an investment manager in the crypto space, focused on private market strategies. So we run a venture program, as well as a public strategy and a hedge fund. So really covering the waterfront of what we see as a major growth area within broader tech, as well as early stage risk. This is outside of Bitcoin, Ethereum, and Coinbase. Everything is less than 5 years old. So I think the investment managers that are dedicated to the space have formulated ways of staying ahead and learning from sort of the market and their portfolio companies in order to see where the puck is going. Prior to CoinFund, I had a career on Wall Street. I was in credit, high yield leverage finance, and worked for a publicly traded private equity firm called American Capital. And there I focused on a number of technology sectors, payments, SaaS, fintech, among a few other things. And what's relevant is this transition from private equity to crypto felt less risky. It felt like when we look out and think about the digital world, nearly all asset ownership, and there are all kinds of things you can do with programmatic business models that are super applicable. And I definitely draw on a lot of the experience of company building and investing in the private equity context when it comes to, how has the business model around crypto changed, and what are they capable of from a company perspective, not necessarily just a pure currency perspective. So that's kind of our orientation. Some early authorship I did in the space is helped write Coinbase's digital asset framework. This was sort of the initial implementation of, what they should be looking for in digital assets and what might be interesting to their customer base.
Wonderful. Thank you so much. I think that to be on the crypto panel, you need to meet at least one of two conditions: having worked for JP Morgan in the past, or having authored a book. And I think that some of our panelists have managed to do both. Okay, Pat, over to you.
Thank you, Julia. And it's a great pleasure to be here with this panel. Thank you to Marty for the invitation. I'm very much looking forward to it as well. Just very quickly, my background is Wall Street, 25 plus years. I ran groups at JP Morgan, Bear Stearns, and at, to your point, and also Credit Suisse. I got involved into the crypto space about 4 years ago. And just one interesting note about that is when I started looking at the crypto space, I went to open a Coinbase account. And when I went through the whole entire process, they informed me I already had an account that I had formed in 2014. And unfortunately, I never bought anything at that time, but that was a good learning experience. When I got involved in crypto, we started Oasis Pro Markets, which is a broker dealer, and we went through the process of approvals with the regulators. So we're heavily compliant and regulatory forward. We're in this entire digital asset security space. The uniqueness about us is that we are registered for digital cash, which includes Bitcoin, ETH, stable coins, and CBDCs for digital securities transactions. So when we launch at the end of Q1, we'll be able to do instantaneous settlement across a spectrum of securities, from equities, fixed income, structured products, SEC registered funds. We're very excited about that, and we're building quite a group of listings for that. We're also very focused on the DeFi space, so that's where that crypto connectivity is. So we're a bit of a TradFi bridge to DeFi. Our main backer has been MakerDAO. Maker, for those who may or may not be aware, is 6 years old in the DeFi space. It's often called the granddaddy of DeFi, and it's survived, and it's got a very sustainable platform. Their interest in partnering with me about 3 years ago was to bring real world assets, such as digital securities, into the DeFi space. So that's a large area of focus for us. Thank you again. I look forward to the panel.
Thank you. So I will pose a number of questions, and if you don't mind, this feels like a great flow. So we'll just go in the same order for each of the questions. And the first question is a two-part. Why crypto? Why now?
So I'll jump in. I guess my question or my answer to that is why not? No, in all seriousness, I think when crypto first really entered mainstream consciousness and everybody got piled in 2017, and there was a lot of hype and so on, there was one thing that really jumped out at me, and that was more than the crypto itself. It was the underlying technology. And so I would say for me, it's why crypto, why now, is why blockchain, why Web3. And so for me, that's the larger conversation is around the underlying technology. And why now is because it's able to have us do things, or it's enabling us to do things that we couldn't even have dreamt possible with current technology and Web 2.0 infrastructure. So for me, the excitement of why crypto, why now, is really why Web 3, why now. And that's because we're ready for that. There's a new wave that's happening. It's going to be lasting a long time, and it's going to be affecting everything that we do in our lives. So for me, the excitement is something that's very foundational, very transformative, and it's enabling us to do things that we just we can't do right now. So that's my shortest answer to that question.
Thank you. Franklin, over to you.
Thanks. And that's a great answer. For me, in terms of why crypto, why now, I really point to two trends that I think are really important here. One is that, at least in the US, our government has printed more money in the past year than it has in its first 200 years of existence. And that really is, I think, one of the most important things to note about today's macro environment. So when we look at crypto assets as an alternative financial system, an alternative store of wealth that folks can look to when their local institutions are starting to essentially dilute themselves and weaken the value of the assets on the traditional rails that we all complete our financing and payments and every other type of financial transaction through. I think folks are looking to crypto and to Web3 as an alternative, as an exit path from monetary policies that they may not necessarily agree with, and also as a diversification away from that. You don't necessarily need to be a complete non-believer in the future of the dollar to say, hey, it makes sense for my portfolio to have some type of hedge here that's not correlated with what's going on in central banking today. And the second trend, I think, is less financial and more technological. When you look at the web today and the platforms that we all gravitate towards, whether it's Apple or Facebook or Google, I think we're at an inflection point now where those major platforms are moving from being the biggest innovators of our day to soon becoming the biggest regulated utilities of our day. Technology has become, I think, such a big, important piece of just everyday life that we're starting to see regulatory pushback. And eventually, I think, quite soon, we'll see that this new phase of being regulated utilities in the technology world will make it so that their moat is regulatory rather than innovation. And in that world, Web3 and being able to build on decentralized networks kind of goes back to how the internet was originally kind of envisioned. And the fact that smart contracts are taking the place of a lot of these platforms kind of opens us back up to where the innovation is going to be in the future, which I believe is going to be on blockchains.
Thank you, Franklin. I find it fascinating that we now talk about shorting a monetary policy. I think that's really cool. And the fact that you could be, as Pat mentioned previously, you could be regulatory forward. I wrote that down because I've not heard that before. All right, we'll continue. Alex, please.
Great, and I'd love to kind of build off what Franklin was saying. I think it's extremely important that this is a consumer and developer driven kind of innovation and revolution. It's bottoms up, not top down. And what I mean by that is, there's some other examples of that in our past, whether you look at, the digital music industry ignoring MP3s for about 7 years until, finally being forced to adopt them because of the widespread usage by many consumers. You look at, the sort of regulated utility nature that Franklin describes around platforms, but also that their power is untenable for developers. So the fact that the Apple App Store can rug your application and destroy your business is something that, now that there's a better solution, why would you expose yourself to that risk? When Twitter shuts off its APIs, when Facebook shuts off its APIs, Zynga cut in half, right? So it's kind of this solution to a problem that a lot of consumers don't yet appreciate, but the developer community is gravitating towards, and I think they can deliver on their promises of building really interesting products and services that are transparent, are open and accessible, and in fact have a number of key characteristics that allow them to flourish and be adopted globally. So I think that it's more than meets the eye in what can I do on a blockchain, and it's kind of this rearrangement of the technology stack that pushes aside some of the platforms and the power that they've amassed and sort of allows a new set of infrastructure for applications and the next wave of developers. Now that's kind of not it. It's also, you know, kind of bigger than Web 2 in it's reorganizing financial markets. So, you know, a couple of the pulls are 24/7, you know, global accessibility, you know, transparency, both Pat's perspective on, you know, just when Maker has an issue and you're looking at, you know, borrow lend protocol, you know exactly what, you know, what's behind that issue. You know exactly how much, you know, the system might be impaired. And that's kind of a level of transparency we haven't seen, you know, in traditional markets, and you know, especially reminded after the last credit crisis how messy and complicated it is to you know, to unwind a bunch of, you know, intertangled businesses. So I think that's super important. And then at its core, it's really just a coordination mechanism. So how can I, you know, think about the future of buyouts and a group getting together to, you know, both pool money, you know, create a governance structure of how to own that asset and own it together. You know, how can I think about, you know, the future of marketplaces? Well, you know, I may not know that Franklin or someone else owns a specific NFT, you know, this CryptoPunk, let's say, but I can communicate with him. I can sort of either bid on his asset or I can you know, message him about his asset. So it becomes this really global marketplace that's exciting for you know, people who are used to having gatekeepers as intermediaries. So whether that's a broker on a private, you know, company stock transaction or many other use cases that I think will you know, unfold over the coming years here. And be pretty exciting, and all the products and services that are being developed to support them look very much like, you know, things we see out in the traditional world, but it's innovating on the SaaS you know, business model and turning it into to pay as you go. So
Thank you, Alex. Thank you so much. Let's, I know that Radhika wanted to make one quick additional point, and we'll go to Pat, because we have still so many questions that we need to go through. Radhika, go ahead.
Sure. Just a quick point I wanted to make, Julia. Thank you. And that is that, you know, if you think about all of the things that all of us as panelists have been talking about, there's one thing that keeps popping up, which is ownership, right? If you look at current Web 2.0 models, it's basically a single entity owner type of system. And we as contributors, creators, et cetera, individuals that are part of this larger community just don't have the rights and ownership that we need to be awarded. And so for me, when I look at Web3 and why this is so exciting and so disruptive and transformative, it's because this democratization of platforms so that it equalizes ownership in the community across the platform is something that's very compelling. So I just wanted to add that.
Yes, thank you. And Alex, thank you for so many excellent points. Pat, over to you.
Terrific, thank you. And you know, I agree with all the comments Franklin and Radhika and Alex shared. There are tremendous benefits. Just going back to the original question, why crypto, why now? Well, that, you know, I was a skeptic 4 or 5 years ago, and that's a question that you could ask every year. What I would say is, if you look at crypto, it's higher lows every year at the end of the year in regards to where prices are. The trend has been upward, and a lot of that has to do with institutional adoption. Certainly, it's all, to Alex's point, it's been consumer and developer driven, but now that you're starting to see that transition into the mainstream. And what we see is, why now? When we started this journey with Oasis on the regulatory front, we would have discussions with a number of large institutions. Some names are like Bank of New York, State Street. And at the time, they were just forming their crypto strategies or blockchain strategies, really. And, you know, fast forward 2.5 years, and they have ample groups, growing groups. Many of those people that we were dealing with have moved on to other types of projects. And so we've seen this growth in the institutional marketplace, which to me, and it continues to grow, and it's growing exponentially, which signals to me that the opportunities are becoming greater. So regardless of where the prices are, I think those of us who invest in the market or are long-term holders, had an interesting time over the last couple of weeks where asset prices in crypto dropped about 30 to 40% across the board. But from a long-term perspective, whether it's 2022, we'll ask the same question next year in 2023. There's a real opportunity here. And if you look at it from a family office perspective or a financial perspective, looking at just higher lows every year, going back to 2016, I think it gives a lot of comfort in volume increases to this entire area. Just a couple of quick comments. So we're talking about crypto, but I think Alex and Franklin had also mentioned blockchain.
Yeah,
that's the cornerstone. So what we do is we're taking advantage here at Oasis. Now we have crypto in terms of digital cash, digital securities, blockchain, but it's really that underlying blockchain technology. It eliminates poor documentation. So back in 2008, there was an AIG issue. I don't know if everyone recalls that with Lehman Brothers. And no one really knew what the exposure was when the financial crisis hit. That was due to poor documentation. With smart contracts, being able to put the documentation in digital securities or digital assets, you eliminate that. You eliminate counterparty risk, almost perfect transparency, almost immediate settlement, like what we're seeing on the crypto side. There's just tremendous amount of advantages to this technology alone.
Wonderful, thank you. Next question. Again, it's a two-part question. What is the outlook and where do you see the biggest opportunities?
So I'll start
Radhika.
again.
Radhika,
sure,
that was you.
Julia.
Yeah.
So the outlook for 2022, I think there's several great sectors that are already showing signs of growth, and that continued growth is going to continue. DeFi is still going to be pretty hot. So we've seen Uni, for example, and Aave and those others, and so DeFi projects are going to be really continue to be on the rise. Anything regarding payment solutions in general is going to be on the rise. Then we've got a whole field in the metaverse and NFTs. I think that's last year it seemed like it just burst into people's consciousness. It's not when it was actually created. It's existed for a lot longer than that, but I think that everybody realized, wow, there's something really unique and exciting and different about NFTs and metaverse. So we're going to see this crossing of lines or blurring of lines between the real tangible world, the virtual world, the metaverse, and all of that extension of ourselves into the fully digital world. I think is something that's going to be continuing to be a thing. This is not a here today, gone tomorrow kind of phenomenon. I think we're going to continue to see all of that space continue to rise and expand. And then if I look at other kinds of crypto projects, particularly projects that have to do with more impactful solutions, where I'm kind of focused on things that actually relate to healthcare or financial services in general. We're going to see CBDCs, for example, that are still going to be great applications. And as the more we get regulatory clarity in the US, there's ways that that's going to be deployed in the US, but already worldwide, we're seeing big shifts and central banks moving into those areas. So for me, the outlook is really across financial services and healthcare, I would say, are big ones. But there are going to be other areas where we're going to see continued expansion, power and energy, for example, which has already been on a transformation journey. But now with the addition of not just crypto, but blockchain to be clear as the underlying technology, I think that growth is going to, and that trend is going to continue. So, for me, the bullish outlook is on every sector that you can imagine, where at varying degrees of adoption and varying degrees of expansion, we're going to see a very bullish outlook for 2022. Volatility in the markets, well, yes, that's the name of the game. I think if anything new is that, there's going to be existing volatility, but like my colleague on the panel pointed out, what you're seeing is those higher lows as well. So the trend overall is up. And so I think that's really the bigger picture that we can expect to see going forward.
Thank you, Radhika. Franklin, what does Pantera see the opportunities and what's interesting?
Yeah, definitely. I think a lot of the themes that we've been investing into, for the past 8 years have all been kind of evolving into their next phase, which is really cool to see. We've been investing into the onboarding infrastructure or, centralized infrastructure really early on with exchanges like Bitstamp, payment processors like Wire or Circle, where we were in the seed round for that. And I think what we're noticing now is that a lot of that future growth in that sector is starting to look like it's going to happen outside of the US. A lot of the winners have kind of been crowned. And so we're looking at regions like Latin America and Southeast Asia. And I think there's sort of two reasons for that. One is that, the user population there is just ready for crypto. They already interact with their banks through their phones rather than in bank branches, right? So they understand the concept of having a digital wallet already. And number two, I think, is that they're already, unfortunately, familiar with the narrative of currency devaluation or weak local infrastructure. So having an alternative store of wealth and financial system that's independent of any local issues that might be happening is just a really attractive product for them to gravitate towards. So we're actively investing into those regions in companies like Bitso that already have 95% market share in places like Mexico, companies like Pintu in Indonesia. So that's a big area for us. I think DeFi is definitely going to be a trend. It's kind of fallen off of the radar a bit because NFTs have just been so noisy this past year. But I think there's going to be a return to DeFi, and the interest in that is going to really rise because I think one thing that we've noticed over the past year or so is that there's just a whole new level of institutional interest on the investment side. You're seeing late stage growth funds, you're seeing traditional hedge funds and credit funds all start to build out their crypto trading desks. And I think the next step for them is real adoption. We're investing into these products that are financial in nature. Let's start using them. Let's start borrowing and lending through these protocols. And, it's not going to be a huge wave at first, but it's going to be, I think, the start of something very massive. And then on the sort of final piece, I think, is developer infrastructure, particularly around the NFT space. There's a lot of NFT projects getting built, a lot of different brands and influencers coming into this space. But I think the technology still needs to catch up to the interest. So we're looking at things like NFT marketplaces that will succeed regardless of whether a specific NFT project succeeds, as well as developer tools to help people mint and manage their NFT inventories and access the metadata to be able to build quicker, faster, and better. And I think that's the right moment for that type of investment in the NFT space.
Thank you, Franklin. Alex, where are you taking CoinFund in 2022?
Yeah, great question. And I think we've heard a lot of the corners and answers already. We kind of bifurcate the market into, what's tipped, like where are we now seeing, adoption, product market fit, and scaling into, market sizes, and then, where's the puck going? And then another framework I like to think about is, what's going to lead the adoption that then will permeate into other corners. And I think, I do think that NFTs are, the right place for mass consumer adoption that then, spill over into DeFi. You need all kinds of borrow lend tools, to service NFTs. Gaming will push that forward, where NFTs will start to be adopted into games and increasing, the adoption of digital wallets, where people own something in many different experiences. And also Web3. I think you really need Web3 to emerge in order to support both NFTs and every application in the future. but that's just kind of the beachhead market for it. Where is my metadata stored? How is my identity either pseudonymous or sovereign, attached to a bunch of different projects? How do I, stream video through my app? How do I, sign on, in a dynamic way? Where do I keep my file storage and how do I access it? So all these applications that are going to be built require this foundation of services that look, as I was saying, kind of similar to what we see in the SaaS world, to what you need to start a company, but need to be built to be composable with blockchains. We incubated a company called Metaversal in the NFT area, recognizing that owning direct NFTs was not something investment managers could figure out easily. It's kind of the intersection of culture and money, and that company will benefit from helping big IP owners determine strategies in the metaverse, while also sort of owning iconic NFTs. So that was an area we thought was so big that we had to design a specific strategy around it in order to benefit from being very close to its evolution. And I'll pause there, but there are many other corners that are exciting. I guess just to tick off, where's the puck going? I think that's largely kind of DAOs and metaverse, but not a lot of traction there yet.
Wonderful, thank you so much, Pat.
I think the previous panelists, Radhika and Franklin and Alex, covered the spectrum well. I just to add to it, I gaming and NFTs I think are perhaps not just 2022, but I think long term a huge opportunity, and it's already happening in Asia and growing here in the U.S. I believe, just from a 50,000 foot level, really what we're talking about is infrastructure, and be it inside the US or external US, from payment systems to custodians, to trading venues like ourselves and others. That's where the opportunity still lies. A lot of money is flowing into businesses such as that right now, from both TradFi and the crypto space, and I think that'll continue. So to us, that's the area that we've gravitated to now, where it's really fortifying the infrastructure and building upon it. So that's how we look at the investment horizon. And just one thing to add, if in regards to the audience, if they're thinking about investing in this area and haven't as of yet, going forward, my advice typically is don't venture too far. Focus on the large, well-known tokens that you often hear in the news. And on the NFT side, I've talked to some of my friends who are OGs in this space, and what they advise me to do, because I can't figure it out entirely, to Alex's point, of buying one or they just focus on CryptoPunks and Bored Apes, and there's another one called Doodles. So if there's anybody out there who is interested in doing some exploration, there seems to be a lot of wind behind the sails of those three.
Thank you, Pat. Do you need to leave in about 5 minutes? Do we still have that?
Yes.
Okay.
Yes, unfortunately. Thank you.
So because you have just a few more minutes with us, if the rest of the panelists do not mind, I would love to throw the regulatory question to you, because as you know, there are so many banks, for example, that would love to offer crypto to their clients. They're standing by as that product line is being offered by fintechs. And it seems like they need help in figuring out the regulatory aspects. And of course, through your work with DTCC, you have the front seat to all of that. What can you share in terms of regulatory?
Yeah, well, it's a really gray area. On the banking side, the rails are being put in place. it seems. And there's a lot of comments with the regulators from the OCC to SEC, CFTC, and FINRA. That's all occurring, and they're getting more educated, but they're not moving quickly. So there's still a gray area in that regards. So we sit on the executive advisory board at DTCC, to your point, and they came out about a month ago, and we assisted in building this with the other participants with a T+1 blockchain private security framework, which will include digital QSIPs. And that'll be launched at the end of Q1, early Q2. They made an announcement about a month ago. And that's, the other groups involved in that executive advisory board include State Street, Bank of New York, some of the largest transfer agents, some of the largest banks. So, so there is movement in that direction. DTCC, per their announcement, is waiting for regulatory approval. And, we're optimistic that that'll occur. Yeah, there's a lot of positives there, but it's still a gray area. I think Jay Powell's comments yesterday brought some comfort to the industry when he suggested that stablecoins and CBDCs could coexist. That's a 180-degree turn from his earlier comments about stablecoins. Mm-hmm. And stablecoins have been in the news as potential money market instruments, and the regulators were looking at them quite closely. Perhaps their view has changed, but I'm very optimistic that in 2022 we'll get more clarity in that area.
Wonderful, Pat. Thank you so much for being here today. We are being asked to share the panelists' information. Why am I not surprised? We'll definitely make sure that that happens. Pat, thank you for your time today.
Thank you, everyone. Thank you, Julia.
Thank you. All right, so why don't we, before we ask for questions from the audience, and I'm sure there will be many, I wanted to throw a couple of last quick questions out there. First of all, central bank digital currency. What is your view on that? And Radhika, we're going to start with you, please.
So central bank digital currencies actually are, the hottest topic among central bank managers right now. If you are paying attention to what's happening in various areas of the world, it's a geopolitical question. Countries, entire regions like EU, for example, having different viewpoints and looks, perspectives on this. I mean, first of all, why is central bank digital currency? If you look at the reason why we have a central bank, and it's to provide certain financial services to the residents of or population, right, of a country. There's both retail and wholesale side of CBDCs, right? So why digital, right? And then the whole reason why we're going digital is because we can't continue to do the things with the same slow sort of pace at rollout and so on. And there is enough pressure with private, enterprise trying to get involved in the fray, as well as countries like China, for example, putting their spin on this, that really forces this discussion to bubble up to the world stage. One of the things that a reason why we can have CBDCs is to promote financial inclusion. It's to make sure that people are not left out of the financial ecosystem. The other point is to decrease in fees, for example. So, there's multiple reasons why we would have a central bank digital currency, not to mention the fact that we need a more efficient system altogether. But the way in which that it is constructed, that's really the hot topic of discussion, because, if you look at what the big three things that people are concerned about, obviously they're concerned about compliance. Obviously they're concerned about security, but then there's also privacy. So how do you balance the 3 points of that triangle, if you will, and make sure that we're upholding all three? So while you have some geopolitical sort of stances on this, we're saying compliance is good and security is very important, they might not be thinking about privacy so much. So when we have a democratic system like most of us are living in, we absolutely have to make sure that a CBDC is going to uphold all 3 points of that triangle. So privacy is absolutely going to be very important, because we don't want a central bank knowing every minuscule thing that we do on a day-to-day basis or a moment-to-moment basis. So the whole point of having a CBDC is then a larger conversation about how we can do this in a democratic way, in a way that upholds not only our rights as individuals, as citizens of a nation, but also the ability to offer these services that a central bank is supposed to offer more democratically and more equally to and equitably to everybody that resides in the nation. So that's kind of the broadest brushstroke of discussion on CBDCs. But I think that, you know, the existing system, if you look at why now on the CBDCs, is because a lot of the existing systems are not able to address those points very well, if at all. So, I mean, I think there's obviously compliance is the biggest conversation with existing systems, but you have to have the security, you have to have privacy as well upheld. And so this whole balance between the three, again, we're coming to the failings of current infrastructure, current systems, and current rails as not being able to efficiently deliver the promise of what a central bank is supposed to do for you know, inhabitants in a country, for example. So I think that, you know, the way the technology can then change the nature of that conversation and deliver a stronger, more resilient and more secure system, but also more private system, so that it upholds all of those points of the triangle, as I was mentioning. That's really where the future of this is going.
Thank you, Radhika. Franklin.
Yeah, I think central bank digital currencies are going to be a huge boon for the industry. You know, when you talk about how difficult it is to move from traditional financial or payment rails into blockchain rails, I think it becomes pretty obvious that once a dollar or yuan or peso is moved on chain, it becomes exponentially more useful. And I think that's sort of the driving force behind why I think central bank digital currencies are inevitable. You know, it becomes an asset that's instantly 24/7 accessible, instantly able to interact with things in a way that is essentially like an API, and is much more attuned to the way that our today's financial system is really getting built. You know, a lot of the fintechs that are succeeding today, whether it's Square or Plaid or Stripe, they're all payment API companies, right? It's that, you know, assets are now code instead of sort of, you know, physical things sitting in a vault. And so to be able to turn your dollar into a line of code that can interact much more flexibly with technology is a more useful dollar. And people are going to move their assets where they're most useful and most valued. So I think the adoption curve is going to look pretty interesting here once people start to realize this.
Wonderful. Alex.
Yeah, I'll keep my answer brief because I think, you know, a lot of the corners have been covered. But I really subscribe to the view that especially when we talk about the US and its relationship to central bank digital currencies, I do think it'll be a regulatory framework because the government is not a technology company. You know, for many reasons that we just discussed, like building APIs, you know, designing a consensus mechanism, delivering a digital wallet to America, is almost not their role. What their role is to create a safe framework so that when you're interacting with a stable coin, you know that it's backed by real funds, that you can interchange it usefully with many other like-kind stable coins, right? Like we're living in a digital world, everything can shapeshift at very efficient and low fees. So my hope is that they unlock the stablecoin opportunity or the CBDC opportunity, but through a regulatory framework that can be adopted, but that, you know, the private technology sector is really the ones to usher in, you know, the ultimate adoption and utility from a CBDC.
Wonderful.
I think that preserves some privacy.
Thank you so much. Gary, you have a question. Would you like to ask it? Gary? All right, so let me, before Gary responds, there is a question from Victor. Is the amount of power required for blockchain operations going to run in conflict with ESG or EPA issues?
Julie,
Please, anyone? Yeah, we just.
Julie, I'll take a swag at that. So first of all, I think Great question, but you just have to keep in mind that it's not all power consumptive, right? Not all blockchains are the same. So it depends on the consensus protocol. So the proof of work blockchains like Bitcoin, for example, extremely power consumptive. But the proof of stake and other blockchains like we know about, there's Polygon or Tezos or Cardano, for example, all of those, for example, are not proof of work blockchains. And so those are not power consumptive at all. In fact, if you look at the average amount of energy consumptions, people are going to say, well, it's about doing 2 Google searches. It's less than 2,000 joules. So if you look at the amount of energy that's consumed in non-power proof of work blockchains, it's really actually pretty efficient. And so I think there's some great alternative blockchains that have come about that answer that question very, very well. And so, yes, it is possible to be ESG friendly and still operate a blockchain.
I'd also point out that, I think Radhika absolutely covered that piece of it. I think the other fact is that ESG also has 2 other letters. It has the social and the governance aspect. And I think in terms of those aspects, blockchain technology is extremely beneficial. To be able to help people access mature financial infrastructure that otherwise, there's no business case for major corporations to go and build. That's extremely beneficial in a social aspect. And I think, one thing we've been talking about is, some of the monopolies and platforms that are extremely centralized and powerful today. And the governance aspect of being able to, number one, have more negotiating leverage to, sort of argue for user rights or user benefits, I think is a benefit on the governance scale.
Good points.
Wonderful. Alex, would you like to add anything? Because we also want a question from Gary. Please go ahead. Go ahead, add. I don't want to.
Yeah, this is Gary. I don't know. Am I now live?
Yeah, Gary.
Yeah, okay, you can hear me, but you just can't see me. I guess they saw enough of me in that economic outlook panel. So I guess this is the question, and I actually wrote it in the Q&A. Lots of people believe that lots of dollars aren't being reported on crypto. And I saw a very detailed IRS study. I can't find it right now. Maybe I didn't save it, but it's like 300 or 400 pages. It says about $100 billion of profit is not being reported. And, when I talk to people, I'm not a bounty hunter and I don't want to be, but, I see hundreds of people over the course of a year, not so much now with the pandemic, but they'll go and they'll buy something and they'll pay for it in Bitcoin. They've made 5 or 10 times profit because these were real smart guys buying them in a few $100 range. And none of that's ever going to be reported. So the comment I said is if we ever had a really detailed reporting requirement, because the stocks and have a 1099B, and so everything I do is recorded. Even my Bitcoin transactions, which is basically buying and selling Marathon or Riot blockchain with options or whatever. Everything's recorded. So I have no pure Bitcoin. So in terms of that, if you ever leveled the playing field, and isn't that, I said, well, a lot of people have to go into the witness protection program. So, because there seems to be, at least from my side, I haven't really seen anybody that's actually paid taxes on all these small transactions. A few $100s here, a few $1,000s there. Maybe a guy goes and buys Tesla with a Bitcoin, and obviously he's not paying. He probably didn't put that on his tax return. So is that going to be a big problem, or will there be enough power that says, hey, Bitcoin's exempt from this reporting requirement?
Thank you for your question. Who would like to? Alex, we didn't give you enough time to answer the previous question. Would you like to make any extra points, or would you like to answer this one first?
Sure, I'll give an answer. In many ways, yes, very valid question, but it can be thought about in a couple different ways. One is the government. If you look at the tax forms for 2021, and I think it was back in 2020, it's on the first page now. So have you performed cryptocurrency transactions? You check that box or you don't. There's a lot of people who do what they want to do with their own taxes and their own accounts, but it's your responsibility, right? So anyone who's participating in the sector ultimately will have to, report their earnings and pay their taxes. And I know a lot of managers in the space for a long time. It's a heavy lift. I mean, I spend a lot of time on it, but it's your responsibility. So pay your taxes, number one. Number two, I think it's partially the maturing infrastructure. So if you listen to a bunch of FBI studies around, do they prefer criminal activity on the Bitcoin blockchain or they prefer criminal activity in cash? There are more $100 bills that sit overseas, and there's a big reason for that. They prefer activity that happens on the Bitcoin blockchain because it's actually highly traceable, and there's only a few onboarding and offboarding ramps, and Franklin was talking about them in different geographies and different regions. So we're going through a maturity process where the exchanges will have reporting requirements for where that money's going, and those individuals will, feel the weight of that responsibility when they're, performing transactions on the internet. Now, the IRS has been notably absent and slow in providing any guidance, specific to crypto, other than staking and airdrops and treating it as a capital asset. And there's a new problem of cross-platform transactions. So when you use your Interactive Brokers or your JP Morgan account, generally all your assets, stay in the same account unless you make a specific transfer, and then those two, platforms communicate with each other, and you're able to transfer your cost basis and keep everything straight. That's kind of not the case in crypto today, and it needs to be solved over time. And the last point is, the de minimis transaction threshold, spending a capital asset on a cup of coffee. Some fintech apps are able to provide tax reports now. Others are working on it. And people do have to self-report it. It is challenging and annoying. So I think that's an adoption question, an IRS question, and a technological innovation question. Because the bottom line is, like, checking accounts are going away. Like, if I'm a millennial and I own stocks in my account, I want to spend those at dinner. Like, I don't want to sell my assets and go to cash, and I just want to own what I want to own, and I want to spend it how I want to spend it. So I think it's valid questions, and it's upgrading infrastructure and how people are doing things. But I can't comment on sort of the quantum and the number that you're posing there, and whether or not those are U.S. people that are subject to U.S. IRS reporting or not.
Hey, Alex, Marty, Sakata, can you hear me?
Yep.
Yes.
Yeah. So real quick, you actually brought up a great thing about I want to own what I own, et cetera, spend what I spend. But there's a lot of guys out there who you might call hodlers, and they are maximum borrowers to buy crypto. And if rates go up, there may be some calls on the money they borrowed, et cetera. Not only that, but just in general, it's been a long-standing tradition of ultra wealthy to keep their assets and to borrow against them. So do you see a ripple effect from the Fed raising rates 4 times this year, possibly?
I think that's true in traditional markets more than it's true in crypto. Like, borrowing is already super expensive in crypto, but you can also generate a lot of yield on dollars that you have. So the cost of cash is really high in crypto, and therefore I think as crypto matures and that arbitrage between what you can 8 or 9% you can get for lending a digital dollar versus the 0.1% you get for a fiat dollar, I think as the asset class institutionalizes and matures, and there's more cash provided to lending counterparties, that will actually stabilize in the other direction, and it should come in line with how cheap it is to borrow against stocks, and so I think those things offset each other. But the how much risk and how much LTV are you exposing yourself to? That's an area where crypto is notoriously risky, and early crypto folks are maybe have a lot of leverage. I'd suggest reading the Genesis Capital lending report. I just think they do a nice job of outlining a bunch of the dynamics, and some of them are structural, and some of them are in capital markets oriented, and some of them are just who are the profiles of people that are borrowing.
There's another question, I think, and it's that, all these profits of Bitcoin and stuff are not going to the US government, which is desperately in need of capital. And I wrote a note here in my Harvard Business School class notes that I thought, and I'm not getting political, it is the fact that the Obama administration probably will try to spend all the money in the world, and they need to seed an Obama coin to pay for it all. So why don't they just go and get an Obama coin? Biden can say no good Democrat should be without an Obama coin, and stake themselves with 10 million of those coins, and let miners do the other 10 million, and then they're off to the races. And a big chunk of the deficit is then reduced. It seems like they're missing the opportunity there, to make some money off this thing. They're just sort of a spectator. It seems like they're missing something a lot. Do you see anything like that, a Fed coin or something that the government will?
Hey, Gary, that's a great question, but we're out of time.
Okay. Well, next year, next year, think about the coin.
I want to thank all of the panelists. You were absolutely fantastic. It is such an interesting topic, and you have such a wealth of expertise and passion for the topic. So, I would just hang out with you for hours. Thank you so much for being here today. I know that Marty needs to move on. Marty, we need to give this panel next time a lot more time, please.